Before we get started today, I just wanted to say the information in this podcast is for educational purposes only and is not a financial, investment, or legal advice. We are not licensed financial advisors. Before making any financial decisions, please consult with a qualified professional. All investments carry risks, including potential loss of principal. You are solely responsible for your own financial decisions.
Say make money, money, make money, money, money. Make money, money, make money, money, money. Money makes the world go round. I'm the talk around town. Remy gave me the sound.
Welcome in to Just the Tips podcast. You've got your favorite stock jocks here. Bruce, how are you doing?
I'm great, man. Christmas pictures are out of the way. I'm smooth sailing from here on out.
All right, I love it. Holiday pictures in the bag. You're way in front of me. And then today we've got your host George, but I'm going to actually hand off my hosting duties to. We've got our first ever guest, a new guest stock jock today. Luca is in the house. Luca, how are you doing?
Hey, George and Bruce. Thanks for including me. Long time fan of the pod, and excited to be a guest today. Hoping to drive those viewership numbers up through the roof. Myself, long-time private and public market investor, also with some M&A experience. So excited to bring that perspective to the table. We got a few news topics to talk about today, and then we got one SaaS company, if you still believe in SaaS companies, to talk about as well.
One question before we start. Is this the Dallas Mavericks Luca or the Los Angeles Lakers Luca?
It's kind of a combination of the two Lucas. So it's a best of breed Luca. A best of breed Luca.
I was gonna say the Lakers Luca looks pretty good. I would just take that one and run with it. He's leading
This sounds like a code gen company with no real IP. To be honest. It sounds like an AI rapper. I don't know.
No shortage of those. Luca, have you done your holiday pictures yet with your family?
Holiday pictures not done, but we got to get the whole family together. They're distributed throughout the country at this point, but I'm looking forward to Thanksgiving when we will have everybody together, and that's probably when we'll try to snap a few photos and check that off the list.
Do you wear like matching outfits? I bet Bruce went for the matching outfits today.
We do not do the matching outfits. We have done matching Christmas pajamas in the past, but that's TBD to see if that's going to happen this year or not.
I would say, not to digress, just one slight digression. After this podcast, this will be the last time that Luca and I speak until Michigan beats Ohio State next weekend, as we have for the last 4 years in a row. Although Ohio State won the national championship, but I don't think it really counts unless they beat Michigan, and that hasn't happened. So this is our final farewell here for at least a week.
That is true. I have it on good authority that Ryan Day is not going to let up until the beatdown is completely handed out to a double-digit margin in the big house on Saturday. So we will see. And
I've heard that about Ryan Ryan for at least 2 years, and I'm waiting to pay off. But nonetheless, it'll be a good game. I think his job, like every year, is on the line. Although he blowed himself out by winning the national championship last year, so
yeah, I agree with you. He needs to win. It should be a good game, and yeah, there'll be no speaking until Saturday, probably I guess 3 p.m. Eastern time. So
that's right. That's right. And we jump to the.
Let's do it. In the news this week, there's a question around the AI market. Is it a bubble? Is it sustainable? Or do these companies have the kind of gross margin profile that investors are going to find attractive in future years? Are people depreciating GPUs too quickly? What do folks think? Accounting rules say 6 years for depreciating GPUs. More laws says 6 months. So, what do we think about that? Do
Well, I
you think
think,
these things have a useful life at year 6? Can they be
well,
repurposed for some other applications? Certainly, they won't be as efficient as the latest, greatest silicon from Jensen, which we know he'll probably be four or five versions ahead in 6 years, right?
they've got an annual
Yeah.
release cycle. I think Jensen kind of kicked this off right with Blackwell saying the hoppers were going to be obsolete once Blackwell came out, and that was the first time he had kind of raised that comment. So when you have the CEO of Nvidia saying that, it can create some panic. Though I think it really took Sam Altman's moment that we chatted about on the last pod that kind of kicked off the sell off, and then you have Michael Burry coming out talking about the depreciation schedules, bringing that back up, and so it's all kind of brought back up this whole topic again. But it does seem worrisome, right? It's if you're buying these huge amounts of capex that everybody's spending, and suddenly like those are only good for a year or two, like you're gonna have to spend that capex again. It's not gonna get the life that everybody's counting on. So it's a legit fear if you believe that to be true. I don't know, if it is. I think there's arguments that the older chips can be used for different purposes, right? You're not going to be doing state-of-the-art training on them. You're going to be using them for inference and other things, and so you will continue to utilize those assets. But I don't know, Bruce. Do you have an opinion on this?
Yeah, I thought so. The hoppers came out and or were announced in 2022, and so they've been in market for several years now. But I thought that, I don't know, Jensen addressed this directly in the earnings call or separately, but I thought he had mentioned, or someone had mentioned, that all the hoppers are basically running at 100% utilization even today.
It
And
was his
so
CFO who mentioned it. I think Colette Kress.
Colette mentioned it, yeah. So I think that the depreciation schedule, I don't know if it's 6 years, but it doesn't necessarily, I don't think they're necessarily obsolete in like 1 or 2
of the cycles that are coming out with new chips. Like if they can still be utilized, it feels like there's almost an infinite demand for chips today. Even, I mean, Blackwells are probably preferred, but I think the issue, their constraint, or at least folks have talked about, is more finding places to plug them in. That's what Satya was saying, more than like the planned obsolescence.
It's a energy and data center space problem. That's
Yeah.
might be the limiting factor.
At least today. I mean, that could
Yeah.
obviously change, and depending on how much more advanced the next generation of chipsets is, it could make them obsolete quicker. But I don't know. It depends on what you think that curve looks like. I think on today's date, it doesn't feel like they are necessarily, which is why
But
they kind of were I think they were almost directly rebutting Michael Burry and I mean, Michael Burry, obviously, incredibly smart guy. He got his face ripped off on this trade. I mean, on both Palantir and Nvidia. So, I think he's smart. I think he's wrong, but you know, we'll see, I guess, in the future. But
I think it's true. It's interesting if you listen to Satya, who was on, did a couple podcasts in the last month or so. He talks a lot about keeping his fleet flexible, if you will, being able to put different kind of chips and not building anything too fast in a sense, and having different types of providers where he can run different types of silicon in different geographies. And I think he thinks a lot about just having a very agile, flexible fleet and not getting too tied to any one chip, building too much of a data center around any one piece of silicon, and then finding out that, you need to make a big change, or that chip won't support this new model, or hey, we could actually fit the right amount of compute into this data center if we had the latest silicon that had a much better dollar per token per watt, right? Versus you might have a older generation where the dollar, I mean, that seems to be the key metric is dollars per token per watt, right? So.
But that argues for having the latest chip, right?
That argues for having the latest chip, and some things you won't be able to do with older silicon. But there's probably still maybe, I don't know, open source, small language models, maybe a subset of a model that you can run maybe on some of that older silicon, possibly. I guess I don't
Unless
know
you're power
in enough
constrained.
detail. Unless you're
Yeah.
power constrained, yes.
It feels like I honestly am just not technical enough to like opine, but it does feel like there's a spectrum of use cases today, and there probably will be in the future, where you can use older chips for some things, as Luca mentioned, and then you'll need, the next generation chips for, basically building your next large language model effectively. But I don't know if it's binary. It's like you either use them or you don't. There's probably use cases like across the board where they
I
kind
think
of.
that's probably true. I think the other thing I think about, Bruce, is if you just said, hey, give me the latest, let's put Gemini aside because I think it runs on TPUs, but let's say the latest model, let's say GPT-5 running or 5.1 running on, let's say it all runs on Blackwell, whatever it's running on, snap that as a point in time, that model is useful for a lot of things. And you could still run it and get a lot of value from it today, probably for the next 2 or 3 years. Now, we'll be able to do some things at future models on future silicon. Will it not be able to do some of those things? True. But there's still a set of use cases that you could generate substantial business value with on using that model on that silicon today. So I think that argues for what you're saying.
I mean, I kind of wonder, so when I think about like what are the investing implications, you think through to like a Microsoft who's being thoughtful about this and keeping their fleet flexible. I think that makes a ton of sense. But you look at the neo clouds that are just buying up every Nvidia chip they can get. They're being, bolstered by Nvidia, and you wonder why maybe some of these neo clouds, are getting so much business from the large providers, right? And you could argue, look at CoreWeave gets a ton of business from Microsoft.
Mm-hmm.
And so, is that Microsoft's hedge right there to say, hey, we don't believe these chips last, so here, CoreWeave.
Yeah, they're offloading some risk, George. They're offloading some risk.
That, or the other take on it is Nvidia has been very purposeful about not falling prey to having a couple of big end buyers that they become constrained by as well. So they've wanted to seed multiple competitors here, and so you could also say Nvidia's spun them up. Maybe at the Microsoft would love to have that business, but they don't have enough chips because Nvidia is not giving them enough. So that is the other side of it, and it's which one is true? But as we chatted about in this pod before, like I don't think any of us are huge CoreWeave fans. It was more of a valuation challenge. But you could say the same thing about Nebius, right? That we were fans of. Is they're in the same position to a large degree.
Yeah, I mean, I think Nvidia does run a chip cartel, which is incented
Which
to,
makes Jensen the Godfather.
Yeah, I mean,
with the leather jacket.
I mean, with everything. I mean, maybe to transition for a second to like Nvidia's quarter, because obviously it was the biggest event in maybe stock market history. Like, if you were long anything, it didn't have to do with chips or technology or anything. Like, you were sort of like beholden to this earnings report, and they crushed it, I think, across the board.
Yes.
The market response was the opposite of what I thought it would be. It was not only muted, but it went in the opposite direction, which was stunning. I mean, I know there was some other data that came out at the same time, like the Fed is waffling a little bit on the interest rate cut in December. But I mean, this was one of like the most on paper home run quarters I've ever seen from a tech company, right? Like, he beat a $55 billion number by $2 billion on the top line. Their next quarter, they're going to do, I think, $67 billion or something, or $65 billion or something like that, 65-ish billion dollars. And they usually beat these numbers by $2 billion. To put that in perspective, there are 63 business days in the fourth quarter. Like, they're going to do over $1 billion every business day on a hardware product that's selling at 73% gross margins. I mean, this was like a quarter that like ripped the face off the baseball. Like, it was like such a strong print, and the market just shat all over everything. So it was kind of a shocking reversal, I would say. But from my perspective, and we didn't do the disclaimer at the beginning of the show, but we can probably add that in. I think like I don't know if there's better opportunities in this market in terms of like a company at scale, growing faster with more momentum that's trading at a reasonable price. It's like 25 times the next 12 months PE. Like this is a reasonable price to get to buy a maybe the best company in the world right now. So I don't know. It shocked me kind of all around, but we'll see what happens next week, I guess.
Well, we're still waiting for that AI revenue to show up on the back end, right? And that's what everybody's worried about.
Yeah.
So if you,
Well,
is the demand there to support these continued capex levels, and end user demand, end user efficiencies, right?
I mean, yeah, but if you listen to Jensen, he says like,
But Jensen doesn't have those customers. He sees demand from, the Microsofts, the Nebius, the Core, Weave of the world. Like they're buying, but
I think,
they need the next level down,
yeah.
and I'm not sure that's there.
But he thinks one, there's $500 billion of like appetite in this market today that they're sold out for multiple years. And I do think you're right. Like their first level customer is obviously like the hyperscalers and the neoclouds and stuff. But I don't think they're blind to like the end market opportunity and like if there's real end market demand, appetite, like people are using this functionality for real things. Like I think like it's not their first customer, but it's their it's their end user ultimately in some ways, and so I think they still do understand. It's like a car company; they sell to the dealerships, but they know if the customers are driving their cars, kind of thing. I just feel like he's at this point in the cycle, and I also don't think like any of these hyperscalers are in a position to take their foot off the gas, like just given the competitive
I think
dynamics.
I think that's true, and the hyperscalers are seeing resurgent growth. I think as well, right, to support some of the spend. You could argue maybe it's temporary. Maybe it's people doing pilots, outside of coding, and maybe a lot of it's experimentory, and that's probably a question. But the coding market is obviously a pretty big market. That seems to be a $4 or $5 billion market already, right? Or at least headed that direction. So
But you're talking trillions of dollars of capex spend, Luca.
true. Doesn't quite support it yet, does it?
So are you guys, maybe to cut to the chase, are you guys buyers, sellers in this sell-off? Do you see opportunity here, or are you getting spooked yourselves?
I'm a buyer, I think, just generally. Like I think that this is a very I think that this is a very good market. Like there aren't this like systemic risks that we saw in maybe previous cycles. So I don't think this is like 2008. I don't think this is like 2001. I think generally companies are getting, far more productive, more efficient. They're going to get more profitable with less operating costs. And I think the hyperscalers are continuing to exemplify the fact that they're the greatest money making machines that have ever been created in the history of the universe, and they're funneling all that money to Nvidia. So specifically, I like Nvidia. I mean, Nvidia's going to do more free cash flow than Amazon, Google, and Microsoft. And so I really like Nvidia as a specific name, I think, which like, is the most maybe consensus bet of the entire decade. But I like the market in general too. I think like the best companies are seeing a lot of strength. So I like the S&P 7, the Mag 7. I don't know about the S&P 493, but I think, they also are going to be beneficiaries here.
Yeah, I'd make it. I'd leave out Tesla. I'd make it the 6, or maybe scoot Broadcom in there.
Yeah, Avago's a good name.
Yeah.
Yeah, I would say I'm generally positive on the market, although it feels like we're in for some, some little bit of choppy weather for a little while, so we'll have to see. But I think there are some buying opportunities.
Yeah, choppiness creates buying opportunities. If it just keeps going up and to the right, it's always hard to, I think, pull the trigger. So, I personally, I've been nibbling. I plan to continue to nibble. So maybe I'll take a bite of some Nvidia this week.
What do you guys, Bruce and George, think about the business models for these companies that are using a lot of inference and how, the margins tend to be not as good as SaaS businesses, but maybe these businesses are bigger, I think is what people are saying is, hey, the margins may be lower, but the gross profit pool actually might be a lot larger because you're going after the labor pool as opposed to what's traditionally been constrained to software. How are you guys thinking through that, and what are your perspectives on that topic?
My view is, I think in the near term it won't matter, because these companies are growing so quickly that people are willing to forgive their kind of gross margin sins. And that, I think, extends, to private and to public companies. A lot of these companies, we've never seen growth curves like this, really. In the private markets, I think Sierra just crossed 100 million in less than 2 years, and even companies we covered like Nebius are seeing growth that's like we're going from 50 to a billion, kind of thing. And so, and a lot of that is obviously, coming out of their gross margin, but people are willing to forgive anything if you can outgrow the bottom line, sort of thing. Like, as long as your top line can compensate for what's happening underneath it, I think people are generally, like, investors are generally willing to forgive it, especially at the front end of the curve. Like, we will talk about a company later today which is not at the front end of the curve and won't get the benefit of the doubt for that type of thing. But I think a lot of these companies that we're talking about now in, like, the AI world, whether it's on the public or the private side, they can just tell investors they're going to 3x or 4x or 5x or 10x, and they're doing it at such large scale that people are just like, I didn't hear anything else you said after that.
I mean, I think the great example, right, that some people pointed to was Cursor, which is now AnySpear, as an example of a company that's just has horrible margins, like especially sitting on top of a model. So Cursor, for those not familiar, is a programming platform, helps developers write code. The rumor is they have a negative 30% gross margin that they're serving customers with. So they don't even, make it past kind of your COGS. So all their costs that they're spending on, call it their LLMs, et cetera, our data center, whatnot, are spending more than they're making on revenue. And so, that's not a very sustainable business model, at least in the short term. So the question is, like, do venture capitalists and those writing checks continue to fund these types of businesses? How long does it take, I guess, to overcome that? Even the model companies' margins aren't rumored to be that high because of, the high costs. Nvidia is selling that 70% gross margins. You've got energy costs, which are rising because everyone's demanding more. So I think you eventually get there, but it doesn't mean you don't have a fallout before then.
I think that's right. I do think there are things that, depending on what type of application you're building, if you have the data sources and the data to do training and reinforcement learning on it, and you're the face to the customer, you can actually use that data to potentially improve a model, maybe take an open source model and swap it out for one of these expensive foundational model APIs that you're hitting over time. And I think that's probably the bet these investors are making, is that, eventually we have an off ramp where we are going to be able to use, build our own model or use an open source model or some ensemble of models, to where we are going to be able to, see in years, 3, 4, 5 years out, a higher gross margin, and probably not SaaS gross margins, but a higher gross margin and a respectable operating margin type of business is what I think they're betting on.
Yeah, it feels like if you're more dependent on an LLM, like the software is more commodity. Like, you're never going to get the same gross margins that we've seen historically for software, even if, because there's just less differentiation, right? If you're an application sitting on top of them.
Yeah. I think that's the bigger risk is, like, I still struggle with the IP. I sort of, like, alluded to it earlier, but, like, I still struggle with, like, what is the IP for, like, a code generation solution, or even like a Perplexity, or any of these companies where they're basically just a wrapper around somebody else's IP that's, I think been crafted in a way that like the UI is great and it has some user lock-in, but ultimately like they have to pass through a lot of their costs to a different company who's done most of the heavy lifting around the technology side. And like will eventually want to just own that market themselves, especially if it gets big enough. Yeah, I don't know. It still feels like you're a little bit on shaky ground if you don't own the technology.
Yeah, and that's where I think to Luca's point, you need some sort of proprietary data set, and if you don't have a proprietary data set or unique data set, then it becomes a challenge, right? Or your core value proposition is maybe AI modules on top of your core value proposition as opposed to being the whole value proposition. That's almost what you need.
I think that's true. I think the data will be a key differentiator, but I think like imagine like ChatGPT 20 or 50 or something where it can take any new or novel data set from any industry as long as you just plugged it in, and it could do a lot of what like a very bespoke model could do for a specific industry in like relatively no time. I mean,
yeah.
I don't know. I think the data is important like in isolation, but I think like once it's plugged into a large language model, whether that's like a company that's doing it for a specific space or one of these general large language model companies, I don't know if the difference will be big enough. And like the capital resources of the handful of companies that are going to make it are just going to outstrip anybody else by an order of magnitude or a couple orders of magnitude. And so I don't know. I wonder. Like it's kind of a scary long-term proposition. I don't know.
Yeah, I mean, so what you're saying is you should only invest in the model companies. That's the only thing you want to own.
Partly, yeah. I mean, partly it feels like it just depends on how long it takes for these companies, like I think Luca had mentioned it earlier, like this isn't Moore's Law. Like if it took 2 years for us to get twice as good with every model, then I'd be like, yeah, we got, 10, 20 years before everything, compresses. I mean, these models are getting twice as good every 3 months. So I just, if that curve continues, maybe that curve doesn't, maybe it flatlines over time. I just think the time scale will compress so quickly that you won't have time to catch up if you don't own these models. I don't know.
So more of an argument for owning SoftBank.
Yeah, exactly. I mean, I think everybody should own like a large language model, like one of the bigger ones, whether it's even if it's like Google or Microsoft or SoftBank and OpenAI, like it just not having exposure to them is just at this point in time feels like a massive miss, like airball.
Yeah. Speaking of Google, what did you guys think of the Gemini 3.0? Got a lot of press and apparently crushed all the benchmarks. Maybe one it didn't. They've got their own TPUs, they've got distribution, they've got the mobile phone. Like, do you see them ever catching up to an Anthropic or an OpenAI, or you think it's too little too late?
Sundaro's strapped, man. Dude, these guys are not fucking around anymore, man. I mean, I think like like Larry is coding again, I think, right? Or Sergey, one of them's coding again in the trenches. Like, I mean, I don't know any billionaires personally, but I think if I did, I don't think any of them would be coding, like actually writing code. So I think this is like an all-out war. I think Google has an infinite amount of resources. I think like whatever Sam said in terms of it, like gonna like be a real economic headwind, or he said something like along those lines, I think is like probably the biggest tell I've heard, like, and the most humble thing that Sam Altman has said in like his entire life. You know what I mean? Like, but I think it just goes to show like how dangerous of a threat Google is, and like these few companies that have access to power and access to chips and access to capital, like I think I think they're very dangerous.
Yeah, 100% agree. And he was smart to go sign up all those deals in the 3 months leading up to this losing the crown from a benchmarking perspective, right? So,
Yeah, 100%.
I know we're not covering Google stock, but don't you get nervous about Google as a stock, given that all their profits come from search, and search feels like if you look at where it's heading, it's maybe away from the traditional links and everything else. And so at least you've heard some companies cry foul on SEO, which Google's not getting paid for SEO, but they're seeing results drop dramatically. HubSpot's the one that comes to mind that rang the alarm there. But that's the golden goose for Google. That's where all the profits come from. Like, it feels like that they cannot stay as dominant in this world of LLMs and people using LLMs to shop. So do you get concerned that Google, while they're doing well on some fronts, they're going to lose their golden goose?
I think it's hard to see a world where they maintain the same share. I think that's probably true. TBD if the overall pie increases or not, I guess, would be the open question.
Yeah, I think if they can build an LLM that allows them to take share, like cannibalize share from their traditional search engine, then it could be okay. I think the pie will continue to get bigger, like it always has, sort of thing. And I think that they're in position to take some of that share. I think the issue is the issue in my mind is OpenAI has really captured the consumer zeitgeist, and I know a lot of people that basically just don't use Google anymore. They use OpenAI. OpenAI hasn't really, I think, turned on the advertising levers and the shopping link levers and that kind of thing. We have an intent to buy and let's monetize that, which is where Google obviously has made a lot of its money. And so I think that's the bigger problem. I think the pie will get bigger, and so that's why I think Google's racing here to make a competitive product. On a group, on a net basis of everything, I'm sure it will impact them. I just don't know what the magnitude will be.
Yeah. Well, maybe we should switch. Maybe we can cover that in a future episode. That would take us a while. There's a lot of moving pieces there, but a very, I think, fascinating company that either value will be created or destroyed in here with kind of the shift in AI. But should we move to our main event?
Let's do it.
Let's do it.
Let's
I'm
get
excited
ready
to hear
to
what you,
rumble.
each of your brain trusts have put together for this analysis here.
Yeah, well, keep the fight fair here, Luca. I'm counting on you to play referee. So,
all right, gentlemen, come out, touch gloves, no hitting below the belt. I want a fair fight. Ding.
It's a little hard because my opponent's in the featherweight category here, and I'm in the heavyweight division. So we'll see.
So it's gonna look even worse when you lose. It's pretty embarrassing.
Are you guys seeing my screen? Last week, Bruce didn't tell me I wasn't presenting the whole time, so.
Not yet.
No, we can't see it. Yeah.
There's something on the Mac here that's denying it. Hold on.
As part of this, maybe we can talk about, what do we think about just the SaaS market in general? And, there's companies like Elise and other companies trying to disrupt this market as well. Although I guess I did a little bit of homework. Seems like they sit on top of AppFolio. So still a system of record, it sounds like, from what I can tell.
Yeah. I think the SaaS market in general, will see a lot of near-term strength. I think they'll get more operationally efficient. I think there's still lock-in. People aren't going to be like, oh,
Yeah.
I'm going to use the new version of AppFolio that some 20-person startup created that promises to be just as good and hasn't integrated everything and has used a bunch of code gen that they can't audit even and isn't SOC 2 compliant. I think there's just so many things that you have to do to get it right, and I think people will do it. That will actually take time.
Yeah.
No matter how good the technology is getting, like they will actually take time to do those things, like build those integrations, and then it will take more time for people to get comfortable with that in
Yeah.
terms of like replacing a system that they've used in the case of AppFolio for 20 years. So, or Salesforce for like, I don't know, 25 years. So it's one of those things I think where if you're one of these SaaS companies, you can see immediate benefits from using AI more aggressively in your own product, and you can hopefully eke out some more operating margin points and gross margin points potentially, and then eventually at some point in the future it'll all come crashing down. But
Well, I think it's a race to see, can you hire does it become easy enough for you to integrate AI into your product in a meaningful way? And can you do it that's not just a bolt on, that is more like a native addition? And can you even go get the technical talent? Because we know this technical talent is really, really expensive and hard to get. But
yeah,
if it becomes democratized enough, and like people, building some of these agentic workflows on top of your application and those types of things become democratized enough that you can actually, these SaaS companies can do that, then maybe they win the right to live another day. I don't know. So, but I
yeah.
agree. There's probably, yes, if they start using it internally, they will see, like every company, the productivity gains and the benefits from a go to market and operating expense perspective.
It's a weird window, I think, where like AI hasn't gotten good enough where it can just take over the world, but it looks like that's sort of on the horizon. It's just a question of how far away that is, in all of these kind of respective spaces. And until it does, like it can be a real catalyst for legacy companies and for obviously next generation companies. But the thing that I think is interesting about this cycle, like relative to other cycles, is like every company of every size and everybody's portfolio is desperate not to be caught flat-footed here, and so they're doing like every single thing they can to like embrace AI, like which has never happened before. Like people never
Yeah.
did that with cloud or mobile or web or anything, and like now people are like, oh, like you'll go to like like a chicken farm and they're like trying to use AI or something. It's like every single company and every single pocket of every single segment in the market is trying to
Yeah.
figure out how to utilize AI.
You have a bunch of people acting rationally, which is creating a bunch of demand, some of which is real, some of which is probably not,
Yeah, yeah,
or some of which is, let's say, experimental, and some of which will be short-lived, and
yeah.
some of which will be long-term, long-lived.
But part of it is also like people don't want like to be they don't want to be Blockbuster. You know what I mean? They like
Yeah.
don't want to be the
Yeah.
one company in their space that didn't do it. And so like they're gonna try to do it whatever that means, even if they don't know.
You're
So
up, George.
All
Get one of your kids to help you on the IT side there.
I wish. I wish. I think my kids are causing the issue, but
Too much Call of Duty on the
be worked.
laptop when you're not there.
I got it. Here's my title. I usually get a lot of flack for my titles, but we're covering today is AppFolio, and it's focused on the real estate or property management market. And so my title is "Don't Evict This Stock from Your Portfolio." Bruce, I'm
yeah,
waiting for your
it's
criticism.
this is like a dad joke title.
I am a dad, so and actually, I'll hold this up. Our audio listeners won't appreciate this, but I do have a dad joke button here that my son gave me. So anytime I need one, it's at my fingertips.
Does it tell jokes or do you just hit it when you make one?
Let's see.
My son asked me if I got a haircut. I told him, no, I got them all cut.
That is
That was a
definitely a
good
dad
one. That was
joke.
a good one. All right, I
They just
like
keep
that.
coming. All right, moving on from the dad jokes. All right, so AppFolio is ticker APPF, and it is, I believe, traded on the NASDAQ, if I'm not mistaken. So it is a 8 billion or so market cap company, similar EV. It has been trading this year. It's down for the year. Actually, I have a 1-year stock chart here. So it's been underperforming the market. Even though it's kind of a decent grower, it grew about 19% or is expected to grow 19% for calendar year 25. And it's continuing to increase in profitability. However, they've run into a little bit of slowing of growth around some of their units and other things. But really what they do, I'll talk through here on the next slide, which is they're really kind of like a operating system for landlords. And so they have a core solution that they sell to help you kind of automate running your property. So think of yourself, if you're a landlord running a multi-unit apartments or multiple apartments, this can come in and kind of be that operating system for you. And so they have a basic solution there that you can subscribe to, and then they have premium solutions on top of that that add different features and functionalities. And that's really where they started. And so today you see that they have kind of a core offering that's very basic. They've added different things like a marketplace, a CRM, APIs that you can plug into other systems. So you can subscribe to different solutions there across the board. And that makes up about a quarter of their revenue today. And then they started rolling out new solutions and providing more and more value to these landlords. And so they do things like automating payments. So instead of having to take checks in, you can do digital payments through their platform. For landlords, they'll help you screen tenants. They'll help you get renter's insurance as a resident. So they'll offer services to residents as well. And when you look at their model, they have both kind of a steady subscription business as well as things that are consumed on consumption, like the screening, the insurance, as well as transactional. They're taking a cut of your payments every month. And so it's really kind of a multi-dimensional pricing model there, but that's really the solution that they offer folks. When you look at kind of why they've come under pressure, I was kind of talking about this up front, and I'm moving through these quickly, but one of the core metrics that you look at is how many apartments are using the platform, how many units as they're pricing per unit per month. And so if you look where the chart starts about, in the beginning of 2022, they're probably about 6.5 million units. Today, they find themselves at the end of Q3 here at 9.1 million units. When you look back at kind of 23 and 24, you were seeing this grow in the low teens rate, and it's been coming down. And then in 2024, kind of the end of 2024, this really took a big dip down into, call it the mid-single digits. So they're around 6%. For the last several quarters. And so that's kind of been the concern is, are they hitting a wall? Are they hitting a saturation point here? In their most recent quarter, we did see a tick back up. So they're approaching 7% in the last quarter, which was a positive sign. But this is really kind of how you can think about, who's taking up their software, who's using it. The bull thesis on them, it's a pretty simple business. But why I like them is, one, I think they have a big TAM and a very desirable, steady market. When you think about the rental market, it's not really going away, right? If you talk about things that are being disrupted by AI, people are going to need places to live. That's not disappearing. And if anything, it feels like more people are becoming renters, not less. So we'll talk more about that. They are, they're a lot of the players we talk about are very dominant in their spaces. They have dominant market share. It feels like they're highly penetrating their markets. I would argue these guys are underpenetrated, and they still have a long runway in front of them. So if you think about a lot of the software names like a Salesforce.com or even a ServiceNow, it feels like everybody has that would take that solution already. And so it's like, where do you go if you're one of those companies? I would argue this is going to be the opposite. They've got a strong innovation history, and they have been able to increase their pricing power over time. They're now starting to do that with AI, so it's got a nice little AI story here. And then the management team, I think Bruce always talks about being led by compounders. I don't know if these guys quite have that track record, but I think it's a strong team for this space, probably one of the better management teams. And then overall, I think, especially with this dip that they've had, you have an opportunity to enter at an attractive valuation. So let's go through all those quickly. So you've got a big TAM and a desirable steady market, as I mentioned. So in the U.S. today, which is where they focus, you have about a 45 million unit opportunity in residential. This doesn't include, there's like community associations out there. That's almost another 30 million. So if you think about where they sit today and kind of their core market, they would say they have about 20% share with a lot of opportunity to continue to expand outside of that even if they desired. Along with that, there continues to be growth in apartment buildings. So we've seen about 1% annual growth in these units, no matter what the economy, right? People continue to need to live places. It's usually the last thing you will stop spending on is your housing. And so typically, even in bad economies, you still see this continue to grow. And then they have opportunity longer term to think about international. And so, again, this is really kind of a market that I think is very desirable, and it's going to continue to be around. Secondly, you have a set of what I'll call kind of more legacy competitors here. So on this slide, for those that can't see, I've got listed, and I borrow this from Piper Sandler. So thank you, Piper Sandler, for the great work you did when you initiated on this company in 2024. But we've got RealPage, we've got Yardi, Entrada, and I'm not sure actually the name of that last one, MN. So you have about 4 other names along with AppFolio. They have about 80% market share if you look across them. And you look at most of these companies were founded in the 70s, the 80s, the 90s. AppFolio was founded in 2006. Entrada is the only other one that's kind of that same genre. So you're dealing with a lot of really old platforms that have been bolting on a lot of different pieces, consolidating different platforms. Some of these have done 40-plus acquisitions to date. A lot of them are either private or owned by families or private equity owned. So they're probably more focused on profitability versus necessarily growth. And AppFolio is kind of the one public company that sits out there that's a newer generation. In addition to having 80% market share, there's probably still a good chunk. It's estimated about 25% of landlords are still non-digital. So you can think about the opportunities, not just, a battle between these players, but it's really a chance to digitize this market that really isn't fully digitized yet. So there's still a lot of runway, I think, in front of these guys to continue to grab share. I mentioned up front, they've got a strong history of innovation. So these guys where they've really shined, we looked at the rates they were adding new units, and so that's gone from the teens to, call it mid-single digits, and now it's starting to tick back up again. But where they've really shined is their ability to continue to add value on top of their existing platforms. And so the one way you can see that is really the ARPU. ARPU stands for average revenue per unit. Over a year. And so if you look back to the beginning of 2022, they were around $60. Today, they're around $100. So they've done that not just by increasing prices, but by launching new features. So the things that I mentioned up front, all these kind of add-ons, be it payments, insurance, screening, these are all things that have really caused that to increase. And so you've seen year-over-year increases going, in 23, they were averaging in the 20s. That's come down more recently into single digits, but it's started to increase again, and their innovation is coming back with AI. And so some of the things that they just released that I think are going to make a difference for these guys is they're looking to help automate more of the repetitive tasks that landlords do. So if you're a landlord, you spend a lot of time responding to leasing requests that are coming in to fill your units. You have maintenance requests, something breaks, other inquiries, and they've launched bots that really help automate this process for each of the landlords. And so Their pricing for these is going to add anywhere from another $150 or up to $3 per month if everyone takes the full bundle here. And so that's been a lot of their recent release cycles really been focused on that. And so we're looking forward to seeing, that ARPU hopefully increase again because of these releases. It's a strong management team. So again, I mentioned, Bruce, you like the compounders. Do these guys look like compounders to you?
Not in particular.
I should ask Luca.
I think I might know the CTO here. Let me look.
We've got some personal connections there for Luca. So these guys, you've got a team that's got a lot of experience at, call it, the big SaaS companies, particularly Shane Trigg, who's the CEO. He joined in 2020, so he's been running the ship here for the last 5 years. He came from Salesforce, having led several of their large cloud offerings, Commerce Cloud, Marketing Cloud. Prior to that, he was at Intuit, running their real estate solutions business. You have a CTO who comes out of the AI space. He was at C3 AI. And so when you look at the AI offerings that they're starting to roll out, it's really driven by a team that's SaaS focused. And so when you compare that versus these other assets that are either family owned or private equity owned, I think they're going to have a hard time competing with a management team that comes from this kind of background and knows how to drive businesses such as AppFolio. And then finally, it's an attractive valuation. So I put in here quite a long list of names. These are all vertical SaaS names. And so, AppFolio squarely fits into vertical SaaS. And what really sets them apart is, the combination of both growth and profitability. So they're not overspending to get that growth. And so where you see that really show up, they're expected to grow about 20% next year, which is towards the top of this list. I've sorted it here by top growers. So up top, you've got Samsara, which we've covered before. You got Figma, you got Toast. Those are the only other ones that are really in that 20% bucket. And then you've got AppFolio, followed by a number of other names. We've probably got almost 20 names on this list. And if you look at AppFolio on an EV to revs divided by growth, they are cheaper than all but one name on this list, and that's Weave Communications, which is a subscale business that dramatically struggles with profitability. They have a very low Rule of 40. And so, there's some reasons why you would see that one being cheap. But they are definitely standing out here on that basis. And then if you also look at them on an EV to EBITDA to growth basis, so if you say, okay, well, I want to look at them on a more of a profitability metric or cash flow metric, they're still cheaper than every name on here but Toast. And they do that with really a Rule of 40 that's higher than most of these names. And so you've got, signs of quality, and yet they're cheaper than everybody. And that's really, I think, the opportunity set that's been out there by some of their slowing growth recently that's starting to turn around. Bruce, you wanted to comment?
What about their earnings? What about their valuation relative to their earnings?
Yeah, well, relative EV to EBITDA to growth. So if you look at that and then you adjust it for growth, they're quite cheap. So they're 1.4.
That's more of a proxy of cash flow, though. I'm saying, what about their PE? If you look at their PE,
that's not that different for a software company.
It's close to 40. They're growing at 20%, so they're effectively on a PE to growth ratio, trading at 2 times their PE growth.
A little less than 2 times, yes. Yeah, it's a good question. I'm surprised their PE is as high as it is. Their EBITDA is 27.5 times, so it is quite a bit higher there. But I don't have a good answer for the difference there. I'd have to go look at that a little more.
I'll cover it in my slides. Don't worry.
But that might be the fastest pitch that I've ever given. But overall,
I think it was.
I know, record setting for me.
I mean, it was pretty quick, and I appreciate it. I think it gave a kind of good overview of the company, and it, I think, underscored what the bull thesis is for the company. I'd like to cover each of the points actually individually, but maybe I'll just switch to my presentation first, and then I'll kind of go through some of those points.
Nice presentation, George. Very thorough. Bruce, good job holding your comments till the end and not interrupting.
He usually doesn't.
I know. We didn't have any low blows, so I,
It's been a fair fight so far.
made officiating very easy so far.
I plan not to be so well behaved during his.
Hopefully it doesn't take half an hour for Bruce to pull his slides up.
Yeah, he loses points for that, doesn't he?
Yes. The judges have noted.
All right.
Oh. Oh no.
I didn't have a great name, so I went for a listening listenership. The title of my presentation is not AppFolio, it's WhackFolio. I was gonna go with Crapfolio, but I wanted to keep it PG.
Not PG-13.
For all of our younger listeners.
I see you have all of 2 slides here, so you're also very efficient, very
I
dense
do. I like to
information.
keep it streamlined. If you've followed along, for both the bull case and the bear cases, I like to keep it punchy and crisp. I also like to use a better format than George uses.
The lasers.
The lasers, but that's neither here nor there. The one thing I'll say, like on George's points, is, I think I can't talk about all of them. So, like, for example, the management team, I don't know the management team, and so I'm not sure like what their track record of success has been, or if they are compounders. So I won't touch that one. I'll talk a little bit more about the valuation, obviously, as I talk about the bear case. On the market piece, like the market, for this technology has always been big, and it's relatively stable. It grows modestly every year. Obviously, you have to put doors into the ground for this market to really expand, and so I think it's one of those markets that's sort of stabilized over time, and like you won't see real inflection. You might see a move from ownership to rentership, over time, but it isn't one of those things where you'll see like a $10 billion gap up because all of a sudden everyone's starting to use AI instead of SaaS or something like that. So I think it's one of those more stable markets, and it is a good market.
Investors like stable, steady. Your end demand is always there. It's it can be counted on. So that's a premium valuation.
It depends on if they want alpha or not, I think. But nonetheless, I think stability does have.
George is calling it defensive rotation in the stock market.
Exactly. I like to call it AppFolio in just one word: growth at an unreasonable price. The other thing I would say is on the competitive side, which I don't talk about. This is a market that has entrenched competitors, especially upmarket competitors, where a lot of the value is. And so you listed a lot of the companies there that are owned by private equity, but I think all of the companies in this space are measured in profitability, and that's what private equity is effectively driving towards. I think the market has been fragmented in some ways, and private equity is very good at buying smaller assets, rolling them in, getting efficiencies, and driving towards profitability. Also, this isn't AppFolio may be the newest company in this market, but AppFolio is a 20-year-old company themselves. And so this isn't a company that's necessarily, fresh off the turnip truck or whatever the expression is. This is a company that's a pretty seasoned company. I wouldn't.
If I had $1 for every time I said fresh off the turnip truck, I'd be, I'd still have $0. Sorry. Go ahead.
So I think it's one of those things where it's like this is a mature market with mature companies that are very competitive, that are all driving towards the exact same thing that AppFolio is. Like AppFolio is not a company, and I'll talk about this, that should be measured on a revenue multiple at all. And none of those private equity companies are either. So this is more of a direct comp to those private equity companies, I think, than anything else. And with that, I'll turn to my slide.
As you're turning your slides, I'm sure we'll talk about the profitability piece, but I will say they they have over 20% EBITDA margins. So it's not that it's an unprofitable company by any means. That's actually the beauty.
No, it's not. It is a profitable company. Yeah, I totally agree. This is a company that is profitable, but that should be measured on profitability, though. Particularly given where they are in their life cycle and where this market is and where they're seeing growth. And speaking of which, that's kind of my first point, which is, this is an older company. I touched on it. That's slowing down, both in terms of revenue growth and in terms of unit growth. And so if you look even over the last 4 years, and it's kind of hard to see here, but from 2023 to 2025, revenue growth went from 31% to 18%. So basically, fell off a cliff, right? They've lost, 13 points of revenue growth in just 2 years. And so it takes them from one kind of multiple category to a much, much different multiple category. And this is the type of growth that I don't think will come back, right? As they project out into 2026, they're also projecting another flat year of revenue growth in terms of, what they'll ultimately end up at, which is closer to 18%. And so as you look at all SaaS companies, whether they're vertical SaaS solutions or otherwise, there's real multiple breaks between 30+% growers, 20+% growers, 10+% growers. And so I think that this is a company that's in sort of the bottom cohort of that multiple class, and it doesn't seem like they're a company that will be able to break out from that, particularly given that it took them 20 years to get to $1 billion in ARR effectively. And so they have much, much higher comps, right, in terms of their ability to grow off of a revenue base that is that big. The other piece is their unit growth has also kind of fallen off a cliff. Like if you look at even 1 year ago at 2024, their unit growth was 19%. In 2025, that unit growth is 11%. Next year, they're projecting that unit growth to be 10%. So they're losing 9 percentage points in unit growth just over 2 years. And this is a company that's seeing real headwinds in both of their key growth categories, which is units and in revenue. I will say that their ARPU, which I think George touched on before, or their average revenue, per user or maybe per unit, has gone up as they obviously have some ability to price, but that hasn't been able to compensate, obviously, for the fact that their revenue has come down dramatically. And part of that, I think, is due to the fact that this is effectively, vis-a-vis the competitors that George has listed, more of a lower market product. This is more of an SMB product. It's not necessarily like a mom and pop product per se, but it's more of like a mid-market to lower market product. Those products and those companies across every industry fundamentally trade at a lower multiple than an enterprise type product or an upper market type product. And this is a company that's 20 years old. Unless something changes meaningfully, I don't think they'll break into the large enterprise type players in this space.
They are starting to see upmarket traction. I didn't talk on that too much, but that is part of their push, and so they are seeing signs of that. I don't have good stats on exactly what that is, but management does talk to that. The other thing I would say about being 20 years old is if you look at when they went public in mid-2015. They were at 74 million in ARR. Today, they're at over $1 billion in revenue 10 years later. So a lot of that growth has really come in the last 10 years. And so, the first 10 years of the company, I think they were figuring it out. But now I would say in the last 10 years is really where they've hit their stride. And they're taking market share. You only do that if you're taking market share. And so, I think the question is, why does that change, across kind of those other clunky competitors? I don't think it does. I think this is a team that continues to innovate. So that's the argument. I think you're making them sound much older and slower than they have been. And really, it's been the last 10 years has been the story for this company. And, the management team's been in for the last 5. So, you have some resets there that are really saying, hey, they're doing something right, something's working.
But even so, like, all of that shows up in the revenue growth. And the revenue growth has come down dramatically over the last 3 years.
I mean, revenue growth for all SaaS has come down, right? And so, it's not out of line. When we looked at that comp table of Vertical SaaS, I had 20 different names on there. I mean, they were the 4th or 5th fastest grower on that list. It's not like they're, if you looked several years ago, there's a lot of people growing 30% that are growing 20. They're right in line with that.
I think it might be an indictment on the entire vertical SaaS industry. Like, I'm not saying that you should buy any of these other names either, though.
I think that's probably somewhat true. Just like in private financings, like triple, double is no longer interesting to people, right? And the public SaaS companies, I think, are all feeling the heat because they're not necessarily the the most attractive place to put your capital right now from a risk return perspective, right?
Give me triple, double if it's sticky. If it's here today, gone tomorrow, but grows 10x, no thank you.
Fair. Fair.
The other thing I say, so basically the way that I got to the math too is, they say that they basically have 8,800,000 units and 21,000 customers. So on average, they have 419 units per customer. And like, yeah, maybe that does change over time, but that's a pretty big sample set. And so my view is they're sort of like a 400 unit average customer company. Their ARPU is like $8.70. They're making like $40,000 per customer per year, and their gross margins are 65%. Like, that's a lower software gross margin than you would expect from a true SaaS company. There's probably what I think they call value-added services in that mix, which end up bringing down the margin somewhat. But this is, at the end of the day, sort of like a mid-market SMB ish vendor in this space, and so they shouldn't trade at like an enterprise, like they shouldn't trade at like a CrowdStrike multiple type thing. And so I think it's one of those companies where you have to weigh what their customer looks like, because it impacts their stickiness, it impacts their retention. And so that's kind of the second piece of the bear case. And then the third piece, which we talked about a little bit before, which is, this company's overvalued on a PE basis. I mean, I think like they're trading at 2 times PEG effectively. They're growing 19%. I doubt they'll be able to inflect the growth curve at scale here. They haven't done that in the last 5 years. I mean, unless something meaningfully changes in their product portfolio or in the market, which I wouldn't expect, especially given they have very well-financed competitors in this market, that if they change something, those companies can change something just as easily. And so I just don't expect growth to really change here. And you're effectively paying, 2 times what you should be paying for this company. The other thing that I would look at too, and like I think about this with a lot of companies I invest in, is like, what is it going to take for this company to double effectively? And so you're saying that this company basically has to get to $2 billion in revenue, right? And how long will that take, right? It probably takes 5+ years for this company to get that big. And like, will their multiple change? Will it go up or will it go down in order for you to get to a $16 billion company, right, on a lower multiple, on a lower revenue base? And my guess is that there's more risk to the downside. Like, there's a better chance that this company's multiple trades down, in which case they have to do even better to get to, a 2x here in terms of the enterprise value for the company. And so I just think it's a really hard company to say you're getting a value buy here. The other piece is too, if you look at on the right side of this chart, what I did is this is the S&P 500 versus AppFolio over the last 5 years, and they've lost the S&P 500 over the last 5 years. And these are the 5 years that the new management team took over. And these are 5 years where we're not going to see 30% growth, and we're not going to see 20% unit growth. And they've still lost to the S&P 500 over the last 5 years. And so you have way less risk betting on the S&P 500, and you're still getting better return. You're still getting more, like, well, you're not getting alpha, I guess, but you're not losing money, I guess, to the S&P if you're betting on it. And so I just think when you put all these things together, it's a tougher company from my perspective to get excited about, to get conviction on, and to see any meaningful breakout here. If anything, I think there's more risk to the downside, just given where the company is trading on a multiples basis.
Bruce, can you say for the audience why like 1 times PEG is what you should pay for a company, and when you think about how you think about PEG versus company growth, company, obviously growth is factored in there, but say a little bit about how your framework there.
Yeah, I think so. So PEG is basically just like PE over growth ratio for the company, and like as a shorthand for where PE should trade, a lot of people will say it should trade at around 1 times growth. And so we've actually looked at everything from EV over revenue over growth to, I think George had included EBITDA over or enterprise value over EBITDA over growth. But but it's basically just a way of saying, like, if you look at PE in isolation, it's hard to tell, like, if it's expensive or if it's cheap. But if you look at it in the context of growth, then you can basically say, okay, this company maybe isn't that expensive, right? Like if you look at a company growing 100% and their PE is 50, that could be cheap. If you look at a company that's growing 10% and their PE is 50, that feels expensive. But with just in isolation, without having, you know, the barometer for how fast this company's earnings are growing, it's hard to, you know, it's hard to contextualize if PE is, you know, expensive, cheap, or in the right place.
One thing I would say about this company is, you know, as well as, you know, like PEG ratios, a lot of these ratios have focused just entirely on growth, right? Without thinking through how do you get that growth. So you can grow fast because you're spending a ton of money, burning a ton of money and lighting it on fire, maybe an inefficient growth. But, you know, what that misses is, you know, are they growing responsibly? And that's one thing about this company that I like is if you look over the last couple of years, their EBITDA margins, which I use as kind of a proxy for overall margins, have gone from 10% back in 2015, and now they're at approaching, you know, almost 30% now. And so like and that uptick has continued strongly in the last couple of years dramatically. So I think there's been a little bit of a shift for them in growing profitability as well, you know, faster than growth. And that's been a little bit of the flavor of the market. So I would say, you know, I wouldn't overpenalize them because, again, they're still one of the top growers in vertical SaaS and SaaS overall. Like 20% growth rate is not bad. It started to inflect back up. Their last quarter, and I will say one quarter does not make a trend, but you saw unit growth tick up. You saw the overall growth rate tick up. So they were up at 22%. It seems like they are starting to go up market, and that's paying trends, as well as just the uptake focus on they are comping their folks differently, their sellers. And I didn't go into this too much, but you know, one of the knocks on the last quarter was they accrued for a bonus that no one knew was coming. And it was because they started a bonus program on helping, you know, the team reach a number of new units and value-added services, and the team hit those numbers, which is why you saw a strong quarter last quarter. So they're incentivizing that team now in a different way to drive results, and you're seeing it start to pay off. So they are doing things that I think are inflecting that. But I would say looking at growth alone, back to the original point, is missing the point of they've grown profitability dramatically. So even in 2022, I'm going to squint here at my slide, they were, let's see, actually they were negative 10% in 2015. They were below 10% in 2022, and then today they're expected to be high 20s when they close out this year. So that's a huge increase in profitability. So I think they're balancing those things, and I would not say that, you know, just because they don't have a peg of one, very few companies have a peg of one, you know, that you're looking at the whole picture there.
But they have a peg of two.
All right, Captain Obvious. And that's where the rule of 40, right, comes in. You take growth plus, you know, the EBITDA or profitability margin. I use EBITDA, and you're getting something like very few companies over 40. I have them at 44. So you have a high quality company that's still growing strong. You should expect to pay a little bit for that, but it's not outrageous amounts by any means.
Sounds like we have a difference of opinion about valuation.
Yeah, I think it's a combination for me. I think the value is obviously too high. I think there's more risk to the downside in the near term and in the long term. And I also think, like, the quality of the revenue isn't the best. Like, this is a 65% gross margin company that's selling to the mid-market. I mean, that's, you know, that deserves a haircut on the multiple. So I think you put all that together, and, well, we usually go through our real opinion. So maybe I'll just start, because I think we're getting to that point anyway. I am actually a bear on this. I hadn't spent much time with the company before this pod, so I was kind of a fresh look at the company. I do in general like vertical SaaS. I do think it's out of favor right now. I don't know when it will be back in favor. I think that there are better places, in this market to, drive alpha than it, in maybe any vertical SaaS company, but certainly one that looks like this. I think like the expectation for this company to break out, I think is very, very hard, would be very hard for me to underwrite to. I think, at the margin, could they do better on growth by 100 bips here or there? Probably. Could they temper unit growth a little bit? Could they get better ARPU? Could they move up a little market, like incrementally? But this is a seasoned company in a very mature market. I don't see, a way for them to kind of thread the needle and really change the dynamic in this market or for this company. And so I think it, in the next couple of years will be somewhat more of the same. You'll have some, error bars that go up and down a little bit around, what valuation might look like. But I do think generally there's just more risk, to going down maybe than to going up. And, I'm sitting on the sidelines here. I'm a bear.
All right, maybe I'll go next, and we'll leave our guest for last to break the tie. So, I do like it. I do feel like it's a fool's errand to bet against momentum, and the momentum has been the wrong way more recently. You look at the deceleration across these different metrics, and it doesn't scream buy me. So it's kind of like, it's not a falling knife, but I'm trying to stop the ball from rolling downhill a little bit, which is, not an easy task. But there are signs that they're turning. I think if you look at this company historically, it's been a very expensive multiple company. And so this is the cheapest it's ever traded because of that. And so you could say, are you getting the opportunity now to buy a quality company at a better price? And that's a little bit of the view I take. I think I like it because, one, I think vertical SaaS is cheap. Part of the being, cheaper is, yes, they haven't performed as well as they should. It's not like they're doing horribly by any means. They're still, performing well. They're still growing 20%, still launching new products, going up market. There's a lot of things. But I like that they have like a TAM that really, they can continue to expand into. That's not, I would call, one that just feels like they've saturated the whole market, which so many things we look at, I feel like it's there. So I like that about it. And then I think they get lumped with the vertical SaaS that is a question we talked about even before we got on here. Luca was posing questions like vertical SaaS getting eaten by AI. And a lot of people have that fear because you look at a lot of what vertical SaaS platforms tend to do is they'll automate some sort of, or help you with some sort of workflow in your vertical, that you have to do. You're a procurement person. They help you, do procurement work. Well, that feels very automatable by AI. But this, I would say, is not something that's as automatable, if I can say. Is that even a word? Can be automated by AI as much. It's really a platform that can be enhanced by AI, which is what you see them executing on. And so I think they're getting lumped into a trend that doesn't affect them as much, and therefore you have a chance to buy them at a discount. So I wouldn't say this is like the top idea in my portfolio by any means, but it is something that I've actually in the last week nibbled on just a little bit as prices have been tumbling here. So I'm a buyer. Luca, we're gonna, as a guest, you get to break the tie.
Yeah, I am in Bruce's corner at the current moment. I don't see a compelling reason to own this name yet. I do like vertical SaaS. I do think that there are some vertical SaaS companies that will bring AI to bear in a way that will create a catalyst in their business. I would just watch this one and see if that actually happens, and if they can leverage AI to get some of the benefits that vertical SaaS companies should get, including increased ARPU, maybe more leverage, and therefore higher operating margins, better EBITDA. So I like the category itself. I do think it's a an interesting market that it's in. A little bit of some concerns around the SMB element of being higher churn, obviously, and less sticky. But if they are going up market, if they can turn on some of these AI features and increase ARPU and start to increase unit growth back to the types of rates of growth that they saw in 2023, then I think, I'd be watching for that to happen. But currently it would not be a name I would be adding to my portfolio today, but I wouldn't be shorting it either. So.
All right,
that's where I
fair enough. Well, the majority has had a pretty good track record here recently, so I'm feeling a little shy now. All right, any closing thoughts? Bruce, send me that Christmas card photo. I can't wait to hang it on my fridge.
Yeah, happy Thanksgiving, gentlemen.
Happy
Phil, talk to you.
Thanksgiving.
Have a great Thanksgiving.
Yes.
George, I hope the back gets better soon and quickly.
Yes, only getting
Luca,
older.
Thanks for parachuting in here.
Yeah.
It's been an honor and a privilege.
Always fun to hang out with you, gentlemen. We'll have to do it in person someday
Say
soon.
make money, money, make money, money, money.
Let's do it. All right, with that, there's Make Money.
Money makes the world go round. I'm not talking around town.
Wink, we out.